for the part of the Jobs Act where they appear. So when laws are enacted in this country, they often come in multiple parts, they're long, and the parts of laws just happen to be called titles. It's just the way it is. So we refer to the three flavors of crowdfunding as Title II crowdfunding, Title III crowdfunding, and Title IV crowdfunding. And that word title, people sometimes think has some significance. Like, what is title? It doesn't mean anything at all. You could call it Chapter 2, 3, and 4, or Section 2, 3, and 4. It's just, that's how American laws are written. So the three flavors of crowdfunding are Title II, Title III, and Title IV. So that's kind of big picture overview what crowdfunding is about.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke, and today we have Mark Roderick. Mark is a securities attorney with Lex Nova Law. He's one of the country's top experts on crowdfunding, and we're very appreciative to have him here today. Mark, thank you so much for joining us, and how are you doing, my friend?
I am doing very well, thank you. And thanks so much for having me. Happy New Year. It's a little
you
bit
as
late,
well.
But...
Absolutely. Yeah, we really appreciate it, taking the time. As I mentioned a little bit, pre-call, we have a lot of investors, passive investors that listen onto the show, as well as our investor group and our local meetups. And recently we did, it's kind of some surveying, kind of telling them that we're trying to get a little bit more information, come this year, and a good time to kind of kick off the year is learning about the securities law, especially as we get more involved in projects and, raising capital and things like that. And you're one of the foremost experts in that field. But one of the bigger topics, which you're very familiar with, is crowdfunding, specifically on the Regulation A front, which I don't know much about because I haven't used that or haven't really researched much of that. Would you mind, first, before we talk about that, maybe talk about your background in as a real estate attorney and your new firm?
Well, yes, I would be more than happy to. So my background is I always say I've been representing, or I've been practicing law since about 1840. And during that time, I have always represented entrepreneurs and their businesses. That's been my niche. And when that's your niche, you do a lot of, you help entrepreneurs raise capital because, that's what entrepreneurs do. Everyone needs capital. And so I have been doing that, quite a long time. And then this Jobs Act, the Jobs Act of 2012, it stands for the Jumpstart Our Businesses Act, came on the horizon and was signed into law that year by President Obama. And I realized that this was going to be a huge deal for entrepreneurs, allowing you to raise money online, which you were never allowed to do before. So I decided, well, I'm going to become really knowledgeable about this. I actually said I'm going to become the world's expert at it. And I started to write a blog about it and speak all over the country about it. And things kind of just took off from there. It has become a big deal. It is becoming a bigger deal, every year as it grows. But the ability of entrepreneurs to raise money for their businesses online and thereby reach potentially every investor in the world, and the corresponding ability of ordinary investors, ordinary Americans, to invest in great deals of the kind that they had never been able to invest in before. Those two things together, that is a pretty good formula. So that is where I spend all my time these days and have for about the last 6 years.
And I understand, because when I think of crowdfunding, the first thing that comes to my mind is like, Kickstarter or GoFundMe and those things. And also on the real estate side, CrowdStreet or Fundrise. Can you kind of demystify what the potential is? I understand there's two different platform models that you talk about. I read some of your blogs.
Yeah. So crowdfunding, what does that mean? Well, there is no technical meaning. But as I always say, if you want to sound really cool at the next cocktail party you go to and have all the, pretty girls come over and think you're smart, it's never worked for me, but, maybe it would work for you. But say, when someone says, what's crowdfunding? Say, crowdfunding is anytime you're raising money online. And people will sit there and think, wow, that is a smart guy there. And that's a pretty good working definition. Now, within that universe, raising money online, there are sort of two separate slices, two segments. And one is the Kickstarter Indiegogo world, where you basically, you raise money by asking people for gifts. You get on your knees and say, God, I'm a really nice guy, got a really great story. Would you please give me some money? Mm-hmm. And in return, you might offer a baseball cap, or, a free watch or something. But that's it. You're really relying on the kindness of strangers to try to fund whatever it is you're trying to fund. So we call that donation-based crowdfunding or rewards-based crowdfunding. And I spend very, very little time in that world because there's no laws. You can go online right now, go stand in the street or whatever and say, hey, give me money. I'm trying to start a business. Please give me money. And it doesn't really raise any legal issues. So the other world of crowdfunding is where I spend all my time. And that's when you're not just, on your knees begging for money. You are offering an investment. So, hey, I'm starting this business. Would you like to invest in my company? So you're going to give me money, and in return, I'm going to give you something. I'm going to give you stock in my business, or I'm going to give you my promise to repay you with interest, a loan. So it's an investment. It's not a gift. It's an investment. And for lack of a better term, we refer to that as equity crowdfunding, as opposed to rewards-based crowdfunding. The term equity crowdfunding is a little misleading because a lot of equity crowdfunding is not equity, it's debt. So you have to be a little bit careful. But the point is, equity-based crowdfunding is around making investments. And then within the world of equity-based crowdfunding, there are three varieties, or I often call them flavors. And they are named for the part of the Jobs Act where they appear. So when laws are enacted in this country, they often come in multiple parts. They're long. And the parts of laws just happen to be called titles. It's just the way it is. So we refer to the three flavors of crowdfunding as Title II crowdfunding, Title III crowdfunding, and Title IV crowdfunding. And that word title, people sometimes think has some significance. Like, what is title? It doesn't mean anything at all. You could call it Chapter 2, 3, and 4, or Section 2, 3, and 4. It's just, that's how American laws are written. So the three flavors of crowdfunding are Title II, Title III, and Title IV. So that's kind of big picture overview, what crowdfunding is about.
Okay. And then as far as what is this like more geared to? Is it more geared to people that, want to start large companies, or would it be recommended for them? Like say if you just wanted to start this, buy a bunch of properties, would it be geared to, or is it geared to maybe like a, potentially larger startup, like a Facebook or a AOL or something those lines?
It is, the different kinds of crowdfunding are sort of geared toward different kinds of businesses. The easy answer is crowdfunding is useful, certainly for the small startup, and Title III crowdfunding probably works best for them in most situations. It is great for real estate entrepreneurs. In fact, that's where it's taken off. It is great for companies, that have grown some and are trying to raise 10 or 20 or $30 million. So that, that's probably not a pure startup. It's good for all those companies, from tiny to sort of medium size. It's probably not going, if you need to raise $250 million, you are not going to use crowdfunding, or you're certainly not going to use it for most of your raise. So smaller to mid-sized companies, and then real estate is kind of its own, its own sector. Real estate still is taking, I'm sure, at least 90% of the total volume of crowdfunding is on real estate deals. And you're starting to see some pretty big deals being funded through crowdfunding. It used to be you'd do a single family fix and flip and raise $200,000. And now people are raising $15 million for a single deal. So, those are starting to be some pretty significant deal sizes, if you see what I mean.
Yeah, absolutely. All right, sounds good. I understand through Regulation A, I know there are the different nuances, but you can be able to access or market to non-accredited investors. Is that right?
Yes. Regulation A does allow you to market and sell to non-accredited investors. If you do a Regulation A deal and you sell to non-accredited investors, the non-accredited investors are limited in how much they can invest. They can only invest, it's a pretty big amount, the greater of 10% of their income or 10% of their net worth. You really shouldn't, no one should be investing more than that in a single deal anyway. But anyway, yes, you can do that. You can also sell to non-accredited investors in Title III crowdfunding, which is often called something else. It's often called regulation crowdfunding or regulation CF for crowdfunding. And that's a whole different world. And there too, everyone is limited to how much they can invest. And unlike Regulation A, where the limits are pretty high, in Title III, the limits are very low as to, like, some people are limited to investing only like $2,000, which is not very much to invest. So, of the three kinds of crowdfunding, you can use two of them, Title III and Title IV, to raise money from non-accredited investors. Does that make sense?
Mm-hmm. Yeah, absolutely. All right. And then as far as, is it only limited to U.S.-based investors, or also foreign investors can also invest in these funds as well?
Foreign investors can invest in any of the kinds of U.S. crowdfunding.
Okay. And then as far as I know what the other like 506B, you have any pre-existing relationship requirements at all, or just they see the opportunity, they can be able to invest like day one?
Well, okay. So now we're going to get into a little more complicated territory.
Yeah, I tried to warm you up. I tried to warm you up a bit. Now I guess I guess we're getting deeper into the weeds now.
We are, and I should say, I think you mentioned my blog at some point, but I should say that my blog, like when you're finished listening to this podcast, you're going, what the hell was he talking about? You can at least figure out some of it. My blog has a huge amount of information. And my blog specifically has an article that has been read many thousands of times about the differences between 506B and 506C, because I get asked that question so often. I wrote a blog post about it. So this is how it works. 506C, as in Charlie, is the new animal in the zoo. That's the animal that allows you to advertise, which you couldn't, for 85 years, you couldn't advertise. 506C allows you to advertise, unlimited way, any way you want. But the restriction of 506C is that it's accredited investors only. 506C is also called Title II crowdfunding. Accredited investors only, but unlimited advertising. 506B, as in Bravo, you can tell I come from a military background, Bravo and Charlie. So 506B is actually what Rule 506 used to be before the Jobs Act. There was no 506B or C, there was just Rule 506, and it is today 506B. And Rule 506B differs from Rule 506C in a couple key ways. One, in 506B, you can admit up to 35 non-accredited investors, whereas in 506C, you can't have any. So that's good. You can have up to 35 non-accredited investors. The flip side is that, as has been the case for 85 years, if you use Rule 506B, you cannot advertise. You cannot advertise the deal. And here's where we're kind of have to listen carefully. So I don't know whether you ever watch golf tournaments, but if you watch golf tournaments, they know the kind of folks who are watching, older middle-aged men, anyway, that's the demographic. So they have all these advertisements for investment banking firms. And the advertisement is always, an older guy, his wife who's, 25 years younger, and, they're on the golf course or doing something fun. And, the message is, hey, if you use our investment advisory service, you'll be able to retire and have a young wife. Those are Rule 506B advertisements, because you note when you watch those ads, they don't specify any particular investment. They don't come on during the Masters tournament and say, hey, we think you should invest in Facebook, right? They don't do that. They're not allowed to do that. Instead, they are advertising themselves. They want you to call them, and then they'll meet with you. You'll come into their nice office. They'll have you fill in a bunch of forms. They will get to know you. And then and only then are they allowed to start showing you deals. Well, that's how it works in the online world also. So if you're a real estate developer, for example, and you have an apartment complex, if you use Rule 506C on your website, you can show a picture of that apartment complex, and you can say, here it is. This is the location. Here's the deal I'm offering.
Mm-hmm.
And you can have all that right on the face of your website. If, on the other hand, you're going to use Rule 506B and you're that real estate developer, what you do is you have a website about yourself. We're great developers. We've been in business for 25 years. We have nice families. We're honest people. And you get people, just based on that advertisement, to sign up at your website, and then you get to know them. You have them fill out forms. You have telephone conversations or meetings with them. And then and only then can you show them the deal.
Mm-hmm.
So that's Rule 506B. That's the difference.
Is there any time limit from the time that they meet you to the time you show them the deal, like 30 days, or is it kind of like a gray area?
I can see you've heard some rumors out there. There is no established time period. For a long time, people said you have to wait 30 days. That is not true. There is no time period. You do have to, however, take some steps to get to know your investor. That's what it's all about.
Mm-hmm. Is that him filling out the form and you guys having a conversation, or?
Yeah, you fill out a form and have a couple of conversations and you should be good to go.
Is it best practice to log all that stuff in case you get challenged?
Oh,
or
yeah.
Is it, yeah.
Oh yeah, you got to keep track of all that stuff.
Yeah, definitely good. Like I said, there's a lot of information is just not sure. So it's kind of, I wanted to make sure and ask you to confirm that.
Yeah, there's a lot of bad information floating around out there. You know, it's just like vaccinations, right? There's bad information everywhere.
Mm-hmm, absolutely. And this kind of one I had forgot to ask you prior when you were talking more about the Regulation A. As far as like if you're hunting deals currently and you're ready to strike, Regulation A wouldn't be something that you would probably set up because it takes some time. What's like a typical time frame for you to kind of get that set up and operating?
4 to 5 months. Yeah, so you wouldn't do that as a quick strike deal.
Mm-hmm.
What you would do using Regulation A is you would create a fund. Okay, let's again say you're a real estate person, and you'd like to buy, maybe 10 multifamily communities. So you want to have the money accessible to you so you can strike when the iron is hot, right? So you'd raise a fund, try to get people to give you, say, $20 million. And the fund would say, hey, we're going to choose the communities when we find them. See what I'm saying?
Mm-hmm.
So you could, and people do, use Regulation A for that purpose. But you wouldn't use it for a particular project that you had to close on quickly.
Makes sense. Absolutely. Yeah, perfect. Yeah, so that kind of covers most of the stuff there that I had, which was kind of burning a lot of our investor group was, really timeline and kind of, and then as far as any cap, as far as what the amount you can raise, I understand that the different tiers, one is 20 and one is 50. Can you kind of further explain that?
Yeah, so Regulation A theoretically has two components, Tier 1 and Tier 2. And the rules are slightly different. In Tier 1, you can only raise 20 million. In Tier 2, you can raise 50 million per year.
Per year.
But because of some of the rules, almost no one should ever use Tier 1. So although it's academically maybe some interest, and if a lawyer is going to stand on a stage and talk about Regulation A, then they talk about the Tier 1 rules and the Tier 2 rules. But actually, that's a waste of time because Tier 1 should almost never be used by anybody. So, I'm sure you're saying, well, why is he saying that? And your listeners are probably saying the same thing. The simple reason is, although Tier 1 is somewhat more relaxed in terms of what you have to provide to the SEC, with Tier 1, you have to get approval from every state where you're going to sell your securities. You have to go through the same approval process you go through with the SEC in every single state.
From each,
Whereas
from where
in Tier 2,
the
you
investors
don't.
are, where the investors are coming from, or where the project is located?
Where the investors are coming from.
Oh, wow. Yeah, that's definitely limited a lot.
Yeah, so you never want to do that. So you always use Tier 2.
And then I'm assuming each state has their fees and different forms that you have to fill out as well. So
Yeah,
that's
you still
more
have
burdensome.
to file. You have to file little notices in every state and pay their little, their fees, but you don't need their approval for the deal.
Oh, wow. Yeah, I can imagine that, the money and also the time, also the kind of going back and forth, and that can be pretty burdensome.
Yeah, it's ridiculous. Yeah.
And as far as kind of hearing a little about the reporting that's required, is that a quarterly or is it a yearly thing? And then who does that? You have to pay a third party auditor. How does that work?
Well, and here I will interrupt myself again to say, at my blog, there's a whole section about Regulation A. There's a timeline, how much it costs, how long it takes, all the different reports you have to file, which would answer, this particular question. And so if someone is listening and is not, thinking I'm not quite picking all this up, just go to that space on my blog, and there'll probably be a lot more information than you want to read. But,
and I just add to that, I've been there. There's been hundreds of articles on there, so it'll take you quite a while to go through. But yeah, tons of great information.
Yeah, and I had to write all those articles. Imagine that.
Poor you.
Poor me. But so once you do your Regulation A filing, then you have to file a semi-annual report, which is actually pretty simple, and then an annual report, which is longer. And the annual report has to be accompanied by audited financial statements. So those are the two main reports. But then you also have to file periodic reports, like if you're a real estate fund, every time you purchase a property, you have to file a report. If your CFO leaves, you have to file a report. You have to keep all your information updated. It's actually not a huge burden, but it is a little bit of a burden.
Yeah, that definitely. Yeah, that is. And again, you can get really deep, and there's a lot of details that's involved. That's why first research, going to your blog, and of course calling you to kind of talk about your specific situation, and we'll make sure to put all that information into the show notes and send it out in our newsletter to our folks. But for the folks to learn a little bit more about you, and I really appreciate you taking the time with us, what's like a typical work day for you, and do you have any special morning routines besides writing all these informational blogs?
Typical work day for me is like everyone else, I think, in the world, trying to do battle with my inbox. That's the reality for most of us. But I mean, I spend all my time doing deals, Regulation A deals, Title II deals, and all of the corporate stuff, putting together companies, starting new companies, buying and selling companies. But I spend all my time doing deals of various kinds, and it's super fun. I enjoy what I do so much. I mean, obviously it can be stressful at times, but that's the flip side of fun. It's all new. All this crowdfunding stuff is new. So I don't know whether you and your listeners know, but I mean, American securities laws were created back in the 1930s after and as a result of the Great Depression. Part of the reason we had a Great Depression is because Americans completely lost faith in our capital markets, because Wall Street was just a cesspool of fraud and investor deceit. And so no one wanted to invest their money. And when you live in a capitalist country and your capital markets fail, that's a real downer. So anyway, I mean, Franklin Roosevelt was elected in 1932, and one of the first things he did was started enacting what are still today our modern securities laws. Well, you know, they date back to the 30s or 1940, and obviously the internet was not even a concept back then. And so here we have these 1930s era laws, and you're trying to interpret them in the context of a digital society, and that's hard. I mean, some of this stuff is really challenging. And of course, that also makes it fun.
Absolutely.
You know, and it's, I'm very evangelical about this space. I really do think that putting capital in the hands of entrepreneurs everywhere, in all geographic areas of the United States, across socioeconomic classes, and making quality investments available to ordinary Americans rather than just to Wall Street hedge funds, I think can at least put a dent in the terrible income and wealth inequality we have in this country right now.
Absolutely.
So, you know, I'm into it, to use a technical term. And of course, when you're into what you're doing, that makes it that much more fun.
Absolutely. Yeah, like I said, it was just learning more and more about it, and kind of piggyback off you said that giving access to investments for, you know, ordinary folks, to which normally wasn't the case, you know, years ago, which, you know, like I said, new startups, new ventures coming out, and, you know, creating jobs, and, you know, do a bunch of things. It's an exciting time. And I saw this was key to kind of get all the education, you know, speak with yourself, have conversations like this, and just learn more about the space. So somehow we can, you know, get prepared to get involved into this growing movement. So absolutely. To kind of the end it there is, you know, what can you say that you're most grateful for?
You are breaking up on me, and I'm not grateful for that. Is that in any way, is that my connection, or is that your connection?
Yeah, I think it's clear on my end. So maybe it was just a little hiccup there. So, you know, that's our technology. So, but it might be, my question was, you know, what are you most grateful for?
Well, I thank God every night for a lot of things, to tell you the truth. You know, literally, I do. And I have children. I have 2 sons, and I have a granddaughter. And of course, I guess I say, of course, I am most grateful for that. That is, if you have kids, I mean, kids are a blessing like no other.
Absolutely.
In my book. I am grateful for my health. I have been blessed with really terrific health my whole life. And man, you shouldn't take that for granted, because that is not something that is given to many people. So I'm grateful for the skills that God has given me. You know, I'm not one of those people who thinks the world is about me and I've created everything that I have. It's all me, you know. I've been gifted with skills and with a family that was strongly supportive of me, you know, growing up, and paid for my education. And yeah, those are I'm just very, very grateful.
Yeah, very well said.
To have been given so much. I have been given so much in my life. And I remember that every single day.
Absolutely. Very well said. Yeah, it was a little choppy. Was able to still hear it. It was a little choppy. So, but we appreciate you, you know, sharing those words. Especially the most important part of you kind of, you know, gearing us with all of the information and stuff like that. But how do we get in touch with you?
The best place is to go to my blog, which is Crowdfund, spelled the way it sounds, CROWD, fund, and then attny.com, the abbreviation for attorney, crowdfundattny.com. And all my contact information is there, so shoot me an email if you'd like to talk.
Absolutely. We'll make sure to include that into the show notes, send it out in our newsletter. Like I said, there's a wealth of information. I'll just there reading some of the stuff today, and it's very neatly organized. It explains all of the stuff. You have, charts and kind of graphs and everything, and just, this wealth of information. That's definitely key place to start. And again, if they have further questions or inquiries, to reach out to you directly. So Mark, I really appreciate it joining us in the new year. I know every new year it always gets pretty busy, so I really appreciate you taking this time with us. You have a great rest of the year. Happy New Year to you and your family. And like I said, continued success, and we'll look forward to connecting with you again soon.
Thank you so much for having me on.
All right, take care. Have a great week.
Take care. Bye-bye.
Bye-bye.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.